Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday.
Hello and welcome to this week's episode of the Prime Property Finance Podcast. My name is Mark and in today's episode we're actually going to look at the different types of properties and mortgageability. So can be a complex topic in so much that there are lots and lots of nuances within this, but I'll try to keep it as high level and as simple as possible and try and make the point that I'm trying to make in this episode. So let's get straight into it. So who is this for, this episode? It's primarily geared towards buyers. So if you're looking to purchase a buy-to-let property or an investment property, this episode is for you. If you are somebody who has this property type already, you're probably very familiar with the difficulties that you may have experienced in trying to get a mortgage on the types of properties that we're going to cover. So, and this is especially pointed towards you if you are considering buying at auction. Very often you'll find these types of properties at auction because they are challenging to get funded. Therefore, please do proceed with caution. If you find a property on this list, come and speak to us first and we will help guide you through that process before you actually buy it at auction. So where do we start? So picture this. You're a landlord or a first-time investor. You have £100,000 in the bank and you want to get started in investing in property. You literally just want to go and buy something that you can put a tenant in and off you go. You're on your journey. Sounds simple, and in most cases, it's relatively simple, okay? However, there is such a plethora of different property types and considerations out there. As you start to look at the quirkier stuff, and that's probably why they're priced the way they are, then the landscape does change and it can be a little more difficult to get mortgages on there. So I've got a list of a couple of lenders in front of me at the moment who have the sort of exemption list, if you like, those properties that they will not consider. Now, it's worth remembering these aren't exhaustive lists. Just because they appear on a list doesn't mean that you can't fund them with a different lender. But what the point is going to be with this exercise is that it's going to highlight those sorts of properties that you are likely going to experience some degree of restrictions where it comes to identifying lenders that will actually lend on the property. So let's get into this then. What are we looking at? So one that we come across a lot, very popular from an investment perspective, are properties above or adjacent to fast food outlets or petrol stations. The general rule of thumb is anything noisy or smelly can be a challenge to get a mortgage on. So if you've got a flat above a takeaway, for example, whilst that may present itself as an affordable option to buy a property, very often the smell from the cooking and so on and so forth makes the property less marketable. Doesn't mean it's unmortgageable, it means it's less marketable. And what you may see in those instances actually is that the loan to value gets reduced in those sorts of scenarios. Why petrol stations? Well, there's contamination hazards on the petrol foreground, on the forecourt. Also, these sorts of establishments tend to attract crowds, so antisocial behaviour and these sorts of things as well. What's also included on that list of fast food petrol stations is pubs, bars, that sort of thing as well, for all of the same reasons above. Shared ownership properties. So this is where they may have been bought in conjunction with the government scheme of some description. That is going to be a consideration if you're acquiring one of those. I think that's primarily to do with there's a first refusal period on the property and it could be let elsewhere and so on and so forth. So again, just bear that in mind. Studio flats outside of Greater London for this particular lender. So that's something to bear in mind. Minimum square meter sizes for the flats will come into play. Freehold flats and freehold maisonettes are something that you need to be aware of. Flats over 18 metres with cladding unless newly built, where work commenced after the 1st of the 1st, 2019. So you can see this gets quite specific in some of these scenarios. That's off the back of the external wall cladding systems, Grenville, etc. So that is a consideration, certainly in blocks of flats. Ex-MOD flats outside of Greater London. Properties in over 1 acre of land. So ordinarily you would consider that to be a positive thing, especially if you're considering title splitting and all of that sort of stuff. So again, bear that in mind. Having a large amount of land with a property can actually cause more issues than it solves. So just bear that in mind as well. Properties in a designated fracking area where the valuer does not confirm as suitable security. So again, extremely nuanced, but these are some of the things that you may come across when you're looking at properties as well. You'd expect this one, properties with inherent structural defects. They clearly need to be sorted out before they become mortgageable. Properties with an agricultural usage or other planning restrictions. So lenders don't like restrictions of any type on properties, because if in the event of them needing to recover the property, they want to have it a clean route to market to be able to sell that. Grade 1 listed properties, they can be quite challenging to get mortgaged because of the inherent nature of it being listed as grade 1. Grade 2, you'll notice, isn't on the list, but certainly grade 1 appears there. Mobile homes and houseboats are not suitable security, I guess for obvious reasons there, looking at that. Properties in isolated rural locations. Again, what we're looking for, this is specifically targeted, this is specifically around investment properties. Okay, this is not if you want to buy it as your own home. This is a different set of criteria, but again, it's demand for a rental property in that area. Properties where the borrower is effectively both the freeholder and leaseholder. So you may have a share of the freehold, or you may own 100% of the freehold and have a leasehold flat or all of the leasehold flats. That can be a little more challenging. Not always, it's not a huge issue. They just need a charge over the freehold. Some consideration needs to be given to that, especially if you've got more than one flat in that block as well. So yeah, something to be mindful of. Properties built or significantly converted in the last 10 years without a nationally recognised warranty. So in order for a property to be deemed mortgageable, especially if it's built within the last 10 years, it needs the required warranty. So the guarantee that nothing's going to happen to it structurally and so on off the back of that. If it's outside of the 10 years, then it's kind of seen as, you know, what's going to happen to the property would have happened already. So that's something to be aware of. Make sure that you've got the required guarantees if it's a relatively new build property, or if it's been significantly converted. So that's something to bear in mind if you're doing your own development or you're converting a property. Does the level of works require these certificates to be suitable for mortgage purposes? We have seen clients go too far into a development before realising that, and it's been an expensive thing to correct. So just bear that in mind. We have properties located next door adjacent to the applicant's residential property, okay, unless the landlord is a portfolio landlord, okay. The reason for that, they're concerned that you're just going to knock through and have the two properties as your main primary residence for obvious reasons. If you're a portfolio landlord, they deem that as that's less likely to happen. It's just an investment strategy from that perspective on that one. Properties that contain a flying freehold greater than 15% of the total property area. A flying freehold is, you see these coach houses whereby you can drive, so these flats where you can drive underneath them to get into the parking space, the coach house. That is a flying freehold. So there's nothing on the floor between the floor and the first story. Okay, so as long as it's not greater than 15% of the total property area, that's deemed mortgageable for this lender. Single dwelling with a substantially flat roof. Now, flat roofs can cause a problem. It will very much depend on the valuer, how long it was done and the warranty that you've got on that flat roof. But if you've got one house which is largely a flat roof, it can cause you some problems from a mortgage perspective. Back-to-back / sub-sales. So we see clients that will buy and sell on the same day, back-to-back it and make their margin. That's deemed not acceptable to this lender. If you are buying, if you're the recipient of that property and somebody's back-to-backing it to you, that may not be deemed as mortgageable. Any form of non-standard construction. So they consider the following: concrete construction, wimpy, no fines, laying, easy form, not sure if I'm saying that right, and timber frame houses subject to being built after 1970 with brick, reconstituted stone or rendered blockwork. So as you can see, this really does get quite granular in detail. Precast reinforced concrete is not acceptable either to this lender. So I guess what I'm trying to demonstrate here is there is a lot of characteristics out there in property and many considerations that need to be made into, is it suitable for mortgage purposes? Now, some of this you may not find out until you actually get the property valued and you get the feedback from the valuer. Okay, it's now impossible for us to try and think of every single scenario and property exclusion. We do have a look at things like Google Street View. We will have a chat with you around things like single skins. That's another area that needs to be single skin walls. That's another area that needs to be considered, or any characteristics of that property which are deemed to be slightly unusual. But we will try and capture that as much or as best as we can on that front. Now, as I say, this list isn't exhaustive. It's nothing to be scared of either. So please don't take this as you can't get mortgages on these properties. As I say, you most likely will be able to get a mortgage. Somebody's lent against it in the past, or somebody else will, most likely. It just means that the lender pool will be significantly reduced in some of these scenarios. So what does that mean to you as the borrower? Expect higher interest rates, typically, and possibly expect a lower loan to value available to you. So you may have to put more cash in, and you may have to budget for greater monthly payments. Therefore, it may erode some of the margin. However, the counter to that is these properties are often sold at a reduced value because of the inherent issues that it gets with getting mortgages on it. Some may even be listed as cash-only purchases because the agent doesn't realise that you can actually get a mortgage on it. We see that a lot where it's cash-only purchases. We learn what the issue is with a property, find a lender that is suitable or will accept that property type, and we can get a mortgage on it. And that often just fixes the problem and everybody's happy and that deal goes ahead. So if you are concerned about a property and you want us to run it by, or you want to run it by us, then please do get in touch. More than happy to do that. As I say, most properties are fundable and will fall outside of that list that I've just mentioned to you. As I say, this is quite a nuanced thing, but don't be afraid of it. Plenty of lenders out there, and if you need any help, get in touch. So yeah, with that in mind, I think that's everything I wanted to cover off in this episode, actually, around acceptable and unacceptable property types. If you do have any questions to say, please do get in touch, and I look forward to seeing you on the next episode. Thank you very much. Take care.
Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested, and of course subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.